So my wife and I have $2 million of term life insurance each. And we arrived at that somewhat strategically. Like we worked with an insurance agent to implement the policies, but I wanted to discuss how we came up with $2 million.
Are they policies or one policy?
Good question. So we have a joint first to die policy. And so the first of us to go, the survivor will get $2 million. And we bought a term 20 policy. And this was back in, actually, I should clarify. We bought two $1 million policies. One for 10 years and then one for 20. The idea being after 10 years, the $1 million of coverage will drop off. Ideally, we've converted our human capital into financial capital and our need for insurance is lower now. So we can let the one policy just expire. And then we'll have 10 years left on the 20-year term for $1 million. But they're both joint first to die. So whoever goes first, the survivor gets it.
Sensible. Gotcha.
I believe so. And the way we thought about this was we wanted the survivor to be fully covered for life, right? Like when we think about insurance, it really is a spectrum. Like you're transferring risk to an insurance company, and I think the question is how much risk do you want to transfer? And so for some people, they're okay just covering things like debts. They just want to make sure the survivor is able to pay off the mortgage or something like that. And they might expect the survivor to go back to work or to remarry or something like that and worry about their own financial independence afterwards, just cover the debts. We went the full other direction and said, like, look, if one of us goes, we want the survivor to be able to raise our kids, fund retirement, never have to worry about going back to work, never have to worry about, remarrying or finding somebody with money. So one of us dies, the other's set for life if they choose to be, right? And that's, I think, the extreme end. Like when I wrote this thread, a lot of people were like, you're overinsured. And I was like, well, no, that's our goal. Like we had conversations about what we wanted for the survivor, and that's what we determined for ourselves. Not everybody's going to go to that length, but we were comfortable with that.
How much of that decision was predicated on knowing that term insurance isn't that expensive?
A big chunk of it, right? Like our policies, I should say, we pay about $2,000 a year, and we got them when we were in our mid 30s, I would say, and like kind of standard health ratings, like no concerns there. And I think it's about $1,800 annually for the whole kit. So it's very cost effective. So yeah, the amount you need is going to depend on the goals that you have for your family and for the survivor. And if you've got kids, you may want to fund things like education plans for the kids or homes for them, like whatever it is that your goals are. But I'd say at the very, very minimum, the first thing you should consider is your debts, right? And so that's pretty simple. You look at your balance sheet, you tabulate the total amount of all your debts, consumer debts, credit card debts, mortgages, loans, lines of credit, student debts. Just tally those up first. That's your starting point, and I would say that's the absolute bare minimum that you want to consider if you're looking for life insurance. Now, I should specify that I guess there are probably situations where you don't need to cover even your debts, right? Like there's no blanket approach here, but as a minimum, I'd say look at your debts. The second and generally much smaller amount that I added to that was funding things like an emergency account, final expenses like funeral costs. I want my wife to throw a massive party if I go, like 6 figures, like higher bands, like open bar, the whole nine. Assuming I have friends at that point that will actually show up to it, but I wanted to be able to fund like a party, right? Not
you
a
really
somber
thought this through.
Funeral. I think so. Yeah, we'll see if it all works out in the end, I guess. But this is based on conversations from say 5 years ago, and life changes, and that's something that I think is important, and we'll discuss is that you should review this pretty frequently because life changes pretty fast, right? So emergency funds, final expenses, and also any short-term expenses. Like I'm going through a landscaping project right now. If you had that planned already and you knew that was going to cost $150,000 and that was still important for the survivor to go through with that expense, you might want to add any short-term goals that have been planned for but not yet completed or implemented. So that's kind of the second part. And then by far the most complex and potentially important part in our case was income replacement. So the biggest asset for most people is their human capital, their ability to convert their income into financial capital over time. And calculating how much you need for that income replacement can get a little bit tricky. And it depends on the depth that you want to go to. So we don't know how much income we're going to earn over our lifetimes, right? We just don't know. But I think depending on your stage of life, like your current salary maybe, or your current income adjusted for inflation is a reasonable starting point. Of course, if you're fresh out of university with a starting position, you might want to start with the higher salary number, accounting for the fact that you expect your income to grow maybe more rapidly than inflation over the first 5 or 10 years. But the idea is to get an idea of what you think your lifetime income is going to be between, today and your expected retirement date. And that's the amount that you want to cover with insurance. But there's two big things that affect the amount that you want to buy, like the amount of insurance you want to buy. And the two big things are inflation and the expected return on the portfolio that the survivor would implement, right? So if I go and my wife gets, say, $1 million or $2 million, what's the expected return that she's going to get when she invests that money, right? And so if she was really, really conservative, a very conservative investor, I would use a lower expected return for her. Whereas I'm a very aggressive investor, I'm effectively 100% global equities, my expected return is higher, right? So if she were to go, sorry, go ahead.
Why did you go at it from the income side as opposed to the expense side? Can you talk through that?
Yeah, that's a good question. I think that's probably a more. I think it kind of depends, right? Like at higher income levels, you probably want to use expenses. Like if you're a physician earning $500,000 a year and you're only spending $100,000, it's really the expenses that you want to consider.
But expenses and future saving. Like if someone's earning $500,000 a year, right, then they want to be able to replace whatever they were spending. But if someone's super frugal, that doesn't mean they need less life insurance.
True. And so I broke this down into two parts. Like one is just covering the lifestyle expenses, but the other component to this, which you can combine, is calculating the need for retirement income. So replacing the savings that you would have, right? So at the time that we calculated this,
it's not a net present value
income.
of lifetime spending is what you're saying. You're doing like saving, your spending needs up to say age 65 or whatever retirement age, and then the ability to save in that to fund your own retirement.
Yeah, and you can combine those two into one calculation, but the way I broke it down, just in the way that I wrote it so that people understood the two components separately, I did like basically income up to age 65 and then desired retirement income from 65 to say 95. Gotcha. We usually go out to 95 for projections, right? But you could combine that. Like if you're 30 when you're buying insurance and you want income replacement all the way out to 95, you can essentially combine this into two calculations, right?
Right.
Does that make sense?
Yep.
Okay. So the example that I wrote out was for a 30-year-old making about $100,000 a year and expecting a 6% annual return on the portfolio for the survivor, as well as 2.5% inflation throughout the life of the plan. Now, obviously, varying either of those is going to drastically impact the amount of insurance that you should buy for yourself. And there's no perfect way to know exactly how much insurance you should have. So I would say you might want to do this calculation with maybe higher or lower inflation and higher expected returns and maybe take an average. But just this will give you a good idea, at least of a starting point. So with a 6% annual return and 2.5% inflation, you're looking at a 3.5% real return for the survivor. And what I did is I just used a present value of an annuity calculation to figure out how much over 35 years, this person's 30, we're taking them to retirement at age 65, over 35 years to replace $100,000 of income adjusted for inflation at 2.5%, what's that lump sum that they need today, right? And using a present value of an annuity calculator, which just calculates if you were to buy an annuity for a set amount of income, what is the lump sum value that you would need today to purchase that annuity from an insurance company? And there's many good calculators online to figure that out. But in this case, the math works out to around $2 million. So $2 million of cash today at a 3.5% real return after inflation would be enough for $100,000 of income for the next 35 years for the survivor.
Can you clarify how are the present value of the annuity and the expected return being used differently?
Well, I use 3.5% for the annuity.
Oh,
right. So I use the real return for the annuity calculation. So if you go to like a present value of an annuity calculator online, the inputs they're going to ask you for, or what is the income you desire, what is the interest rate, or basically the return, and then what is the number of years over which you need that annuity to pay. And so I use the real return of 3.5% here to account for inflation.
So it's just a present value calculation, not like an annuity pricing calculation.
Because
if you did like an actual annuity, I thought you were talking about annuity pricing. Like if you priced out an annuity for the same thing, you'd need way more, presumably. than if you were investing in an asset at 3.5% real.
Right. Well, an annuity, I guess, at age 30, you would need way more because that would be into perpetuity, right?
Yeah, you couldn't even buy it in the first place.
Yeah. In this case, I specified the number of years that I needed the annuity to pay out for.
Got it.
Does that make sense?
Yep.
Okay. So in that case, you need about $2 million, right? So far we've got debts, we've got short-term cash needs, and we've got $2 million for income replacement all the way out to age 65.
Can I make a couple comments?
No, Ben, absolutely not. You haven't prepared.
So I know what I'm going to say.
I know.
I prepared in my head while you were talking.
Yeah.
One is that when we do this for clients, we use financial planning software and we just like model how much they would need to make their plan sustainable with an early death. I think the way you're describing it is something that anybody could do, but just to be clear, that's not how we do it. We use financial planning software that does Monte Carlo simulation, figures out how much insurance you'd actually need.
Yep.
Personally, I did not do that. I didn't do our financial planning approach. I just used a 2% withdrawal rate and figured out how much, like the same type of thinking that you did in terms of how much would my wife and kids need to fund their ongoing lifestyle. And I just used a 2% withdrawal rate, which is super rough and probably overly conservative, but pretty simple too. So, and just pointing out that the way that you've described how to do this makes sense. There are simpler ways to do it that are probably okay, and there are also more complicated ways to do it that are probably better, but maybe marginally.
But no, you're right. My original question around costs, like over the years when I bought insurance, I always just aimed high because it was such a nominal amount of money to get way more coverage. Like, yeah, the math might say X, but I can get 50% more than X for in the hundreds of dollars more per year. So over the years, we always just aimed higher.
Yeah, I have way more life insurance than you do, Mark. I don't know.
Yeah.
I don't know the intricate details of your financial situation, but I have a nice one-page insurance document that I wrote for myself. I'm looking at it right now. I have $4.7 million of coverage on myself, and my wife has $1 million.
Yep.
She does not earn an income. So yeah, it would be a bigger deal financially for our household if I died. But yeah, very different from your numbers.
So a few things. One, we use fairly advanced financial planning software to calculate this, right? Like my goal for writing this was more towards like if you're getting sold insurance by somebody and they're just kind of sticking their thumb in the air and picking out a number, if you want to go and like kind of get into the weeds a little bit about how to think about calculating the amount of life insurance you need, that's why I wrote this thread. The way you've done it, just basically like dividing by the safe withdrawal rate that you're comfortable with is going to get you relatively close as well. Yep. And like I said, like there's no way to know actually how much insurance you need to perfectly line everything up. And so in our case, at the time that we bought the insurance, my wife was actually earning more than I was. And so it made sense for both of us to have the same amount. And since then, we've had 2 kids and she's stayed at home for the past 5 years. She will go back to work eventually. But now my income is basically the income for the family, right? And so things do change.
Since you updated your life insurance, Mark, that is like the time to update your life insurance is after having a child.
So we actually bought it while my wife was pregnant with our first, right? Nice, so it was anticipation of the first one. So we were aware of that. And then obviously the second one. But I've looked at it since. And as I mentioned before, we have saved a good amount of money since then, since that happened. And so we don't need more life insurance just because we've had a second child, but some people might, right?
Yeah. But go the other way. Think of the number of people that you've met over the years that say, I don't believe in life insurance, or my spouse will be fine. Like, you have to give this kind of math serious consideration. It's no joke, right? And you set it off the top. It's all about who do you want to assume the risk of something happening.
When I wrote the thread.
Go ahead, Mark.
Sorry, I was going to say, when I wrote the thread, somebody reached out to me and said, like, how do I get this concept through to my son? Because they have that exact viewpoint that insurance is a scam and they don't need insurance. And in this case, this individual was quite religious and said that their God would, show the survivor the way. So to your point, Cameron, how much risk do you want to transfer? In their case, they were I guess, spiritually transferring their risk to the deity that they worship instead of to an insurance company, which is just a really fascinating way to think about it. But I wasn't able to really answer that question for that person that reached out. I was like, I don't know how to kind of pierce that veil, or if it's even a conversation that you want to be having with that person, right? But and maybe I think as some people get older and kind of mature and start to see, or if a life event happens that kind of spooks them, they go, okay, like they start to face their own mortality and think, yeah, this is the time to start thinking about insurance, because you never know when you're going to go, right?
Well, it's the other interesting thing, right? People always, when something happens near to you, family member or people around you, neighbors, where someone dies, all of a sudden the risk seems higher, but that doesn't change the basic statistics. Like for me, there's a 1.16% chance of me dying in the next 12 months, of a 58-year-old male dying in the next, as a population, not taking any specifics about my health or history.
Yep.
Just to your earlier point, Cameron, about the cost. So for my $4.7 million of life insurance coverage, I pay $248 a month, which is not, I mean, that's a lot of money. I don't want to minimize that, but it's also, I think, for what you get. And the difference is like, I've got a $2 million policy. The premium is $121 a month. And then 2 other policies that are each $65 a month on different term, like term 10 and 20, for the same reason that you described earlier, Mark.
Yeah. When did you get them? Like at what age?
You know what? I don't have that on my sheet. I have when they renew. I don't have when I bought them.
Because I'm just pointing out that the younger you are, the cheaper it is, right?
Yeah, definitely.
And men are more expensive to insure than women, because women tend to live longer, right? So it's just interesting though, because the younger you buy it, the cheaper it is. So like I'll see young, like late 20s, people getting $1 million, $2 million of term insurance for like $900 to $1,200 a year, right? Like you're talking $100 a month. And you mentioned the cost of, $248 a month being quote unquote expensive. And it's like, I like to say about disability insurance, like if you think the policy is expensive, imagine how expensive life's going to be if
Cameron
you get disabled well, that's just it, right? Like if you
what
can't
you
afford that cost, you can't afford to get disabled or die.
If you can't afford it, you cannot afford it.
Like, exactly.
That's it.
Yeah. No, that's very, very true, right?
Yeah.
Or the old, no matter what, I can drag myself in front of the computer. It's like, really? Over the years, we've seen some pretty horrible things happen to some pretty great people.
Yep.
That rendered them unable to work.
Yep.
Oh man, head injuries, brain injury type stuff. People can't even look at the computer anymore.
Yep. I have a client exactly in that scenario. She got in a car accident and can no longer, she can't use her phone. So when we have to send documents back and forth, we have to mail them now, because she can't use a phone or a computer. If she walks into like an office building, she has to wear sunglasses, because in her case, it's the light that the computer and the phone gives off. But head injuries are
same as the one I'm thinking of.
Yep.
We've seen it happen.
Yep. So the second component that I calculated was just the retirement costs, right? So right now we've kind of calculated your working lifetime income. Now I'm calculating the post-work life income for the survivor for retirement. And it's a similar idea, but you just have to adjust for inflation between now and retirement, right? So basically, and I actually used the shortcut that you described, Ben, like a safe withdrawal rate shortcut. And you do get different numbers doing that, but they're relatively close. So for retirement, in this case, to keep it simple, I said, okay, they also need $100,000 of retirement income for the survivor. And at a 3.5% withdrawal rate, which I know is more aggressive than what you've used, and even more aggressive than what you've shown in some of the work you've done. But for the sake of the example, I hate the 4% rule, so I just basically brought it down from 4%. You just need to figure out what's the inflation adjusted amount in retirement, I guess, that the 3.5% safe withdrawal rate would allow you, or you would need to basically be able to withdraw 3.5% into perpetuity at $100,000, and then you have to adjust that by inflation, right? So for this 30-year-old hypothetical scenario, at a 3.5% withdrawal rate for $100,000 a year of income, they would need $3 million in today's value, which works out to about $7 million in nominal value at retirement, right? These are big numbers. And then just work backwards. What's $7 million 35 years from now? What would you need today at your expected return of, say, 6% to get you to $7 million 35 years from now? In that case, it's about $1 million. So if you have $1 million today and you just park it at 6%, that will grow. This is obviously before tax, but that will grow to $7 million at age 65 or in 35 years from now. And that $7 million at a 3.5% withdrawal rate would allow them to have an income for life of $100,000 adjusted for inflation. So there's probably some shortcuts to this. Like I'm sure I just walked like the long way around, and I've probably done more math than I needed to. But in my head, sometimes I have to make things really, really simple and break them down into really simple steps for them to make sense to me. So that's how I thought about that. So what you get is $1 million for retirement coverage, and then we said $2 million for income coverage during their working career. So you're looking at $3 million now just for income replacement. But Ben, to your point, if you just assumed a 3.5% withdrawal rate on $100,000 starting today, if you divide $100,000 by 3.5%, you get $2.85 million, which is very close to the $3 million. Yep. So that's the shortcut, right? Mm-hmm. So we've got $3 million now for income coverage. If you add in the debts, if you add in, the cash needs, you could be in the $4 million range. And for a 30-year-old, that just seems like an astronomical amount of money in a lot of cases. Like telling a 30-year-old, yeah, you need about $4 million of insurance. It might, on the surface, it might seem a lot, right? And so often what I've seen is insurance agents will say, yeah, but let's go with $2 million, right? Because 4 seems excessive. But if you do a proper needs analysis for a client, an insurance needs analysis, you're likely to come out with a pretty big number. Like I've seen some of my physician clients in their 30s, and we look at their insurance needs, and I'm like, yeah, you need $12 million. And they're like, what do you mean I need $12 million? It's like, well, you earn $500,000 and your spouse earns, $300,000, and you need a lot of insurance to cover off the total amount of income and expenses that you're going to face over your lifetime, right?
But again, how many people have you seen that have smaller policies, like a few $100,000? Oh, enough to cover off my mortgage or whatever. And they haven't thought through the income replacement, let alone the retirement replacement.
Yep. And like you said,
almost
it's cheap
feels like it's just enough to get the sale closed by the agent. I know that's a pessimistic view.
Yep.
But in many cases, that's what it feels like.
I saw it yesterday with one of my newer clients, and we were looking at it, and he has, I think, $1.5 million of insurance. And I ran an analysis using the financial planning software that I use for him. And I'm like, you need about $5.85 million. Like that's the number that I'm coming up with. So you're underinsured by, 75%. Now, if we make these tweaks, like if you were to pass away and your spouse is willing to downsize the home, free up a ton of capital there, cut their expenses by 40%, cut their retirement expenses by 40%, then you're still short, but only $1 million short, right? So this goes back to that spectrum of risk and what sacrifices you're willing to make or not make when talking about your family's goals. We just went like the full meal deal, and Cameron, like you said, is cheap enough. Like, why not just get the coverage? Because you can always cancel this or amend it later. Like you can always get a new policy or just cancel it outright when you've built up the savings and your net worth is sufficient, right? Yep. There's some free online tools that are pretty good, I find, as well. So I've always used, it's a calculator called InsureRight by Manulife. It's just a free tool online that people can use. It's just a little bit more detailed, I find, than some of the other free ones. The nice thing is it will show you also disability insurance, and it will give you kind of a ballpark quote or estimate for what the insurance might cost, given what the inputs that you've used. So I find that's a handy way to do it. And if you're working with an insurance agent, like ask for a full, we call it an insurance needs analysis. So make sure you're getting an insurance needs analysis and not just, a back of the napkin type of calculation. And then, I think the last point is that, like I just mentioned, you can cancel your insurance when you don't need it anymore. And when I wrote this thread, there were a lot of people saying like, oh, you'll always need insurance. What about this? What about that? And like, I have no interest in a permanent insurance policy for my family. Like if I've gotten to the point where I can cancel my term life insurance, it's because that risk has been taken care of. There's no longer a financial risk to my death, and my spouse and kids will be fine, and there will likely be something left for them at the end anyway. So I just don't have a need for a permanent policy.
Yep. Same as me. I bought one once though, sold it to myself when I was an insurance agent.
A permanent policy?
Yep. I had to meet a weekly sales target or something.
Do you still have it?
I don't have it anymore.
Oh, you don't? You dumped it?
Yeah.
I have a very tiny permanent policy I bought ages ago, like $100,000.
Yeah, I ran the calculation of, am I better off canceling it and taking the hit or continuing to pay? And yeah, I was way better off taking the hit.
Interesting. It's tricky because there's a sunk cost there, right? And I think a lot of people have difficulty just dealing with that sunk. Like I talk to people all the time, and it's like, well, I've lost $14,000 to 2 years of permanent premiums, so I'm just going to keep it. But to your point, you need to calculate that cost and whether it's worth keeping.
There's the sunk cost, and there's the opportunity cost of future premiums going into the policy, and the opportunity cost of any cash value that may exist in the policy.
Yeah.
So I got like some small amount of cash value because I'd had the policy for a bit. And then I had whatever, I don't remember what I was paying in premiums, but I can redirect that now to other stuff.
But it's interesting because the commission on that policy, you could have thought about it as a discount to the premiums, I guess, which would have changed the math, no?
Would have changed the initial math a bit, yep.
Yeah, but there's some ongoing commissions with permanent insurance, like on the anniversary date as well, right?
Yeah, but for a policy that size, it would have been nothing, like probably too small for the insurance company to even distribute.
Interesting.
Just love all these true confessions about life insurance. This is good.
I've never bought a permanent insurance policy. I actually just got a quote for a permanent insurance policy for my kids, though. I think that's actually a fascinating strategy. Once you've, I think, ticked all the other boxes, like if your RSPs, your TFSAs are maxed, education funds are maxed and funded, permanent insurance on a child's life as a parent actually becomes a really interesting topic, because when they become adults, you can transfer the policy to them on a tax-free basis. And I think there's a number of reasons why that's not a bad thing. So in general, I have a bit of a disdain for permanent insurance, but when it comes to these policies, I'm not yet convinced that they're bad.
Skeptical.
I know
you've said this to me before, and I've been skeptical, and I remain skeptical. Like you think that the policy growth, because the cash value of the policy is what you care about in that case. You think the cash value growth in the policy will exceed your after-tax rate of return at your tax rate?
Potentially. And I think the other interesting component there is just the insurability question. Like they at least will have some insurance in place. And so if there was something that happened to my kids from a health perspective, they would at least have some kind of form of insurance, and they could use it they can, borrow against it and that type of thing. I just think if you've maxed out everything else, I'm not saying people should just rush out and do this for their kids, but once you've maxed out everything else, I think it becomes an interesting option. I didn't buy it. I got the quotes and I've looked at it. I'm still not convinced, but it's interesting.
But so they have cash value in a policy. Like alternatively, you would have had more money, presumably. Say it's the same amount of money, but unless they need contractual help in the case of their death, right? Because it's a life insurance policy. Like if it's a $50,000 policy, you could just give them the $50,000 as a helpful parent later. Or if they needed to borrow against the policy, you would have had more money that you could help them with later.
Maybe.
Once they're an adult and there's maybe. If you're worried about your ability to give them the cash value of the permanent insurance policy in the future, I don't know, man.
No. I just mean like there's a couple other things. Like in life insurance is far more creditor proof than other asset classes, even like RSPs and stuff. So if I get sued for something later on, that money is still theirs and still goes to them, and that would be protected.
All right, I like that.
And I think and you're gonna smack me for this, but I almost think of whole life as a separate asset class, because you're not, and this is partially your fault because of the permanent insurance paper you did, because when I think of permanent insurance and like the dividends and the cash value are a function of not the performance of the underlying investments of the whole life policy, but a function of the performance of like the block of underlying insured versus their expectations. And I wonder if that's like a distinct and uncorrelated asset class to, say, markets, right? So it is, for me, I don't know, is it diversification? I'm kind of convincing myself of it here, but
it's going to be somewhat uncorrelated because it's going to depend on the insurer's claims experience versus their expected experience, partially, and also on the realized versus actual performance of the participating account, which will be affected by market outcomes. So it's not going to be totally uncorrelated, but the claims experience piece is going to be uncorrelated. But I don't know. I don't know if I'd call it an uncorrelated asset class. It's also smoothed, right? Like the insurance company smooths the policy dividends over time. Like if they have a really good year in the market, they're not going to distribute a much larger dividend. They're going to smooth it out over time.
But that's a feature, not a bug.
Yeah, I don't know. I think it's the same kind of smoothing you get in private asset classes. Private equity looks uncorrelated, but is it? I don't know. I think it's probably somewhat similar with insurance, except for the claims experience piece. Like so there are some sources of policy dividends that are not going to be correlated with financial markets for sure.
And I also think that
make it interesting. I don't know.
Is insurance also a tax diversification tool? Right? Like we've been talking about capital gains taxes and the increase in capital gains taxes. Yes, there's a big threshold for that right now, but if capital gains taxes went up on every dollar to 75% in the future, the sort of marginal decision of whole life versus a non-registered account, I think becomes a lot more interesting, right? And so we talked about tax diversification on a webinar we did yesterday. And I just wonder if it's also, so I think when you look at like the creditor protection, the ability to transfer it to a child tax-free, the potential for diversification through the claims experience of the company, the insurability of the child being intact because at least they have some kind of policy. And again, after you've maxed out things like education funds, tax-free savings accounts, I think it does become an interesting tool to at least look at. I haven't bought it yet, so right, like I've looked at it, looked at the quotes, and
you're paying a lot for if you're doing a participating policy, which is what we're talking about with the policy dividends. You're paying a lot more for that than you would. You could buy. Unless you're going to keep the policy for a very long time and have very favorable assumptions about the future policy dividend rate, you could buy a guaranteed policy that has for the same amount of premium. You could buy a guaranteed policy that's, I don't want to say the number, I haven't run the numbers in a while, but a much larger guaranteed policy.
Like a non-participating whole life policy.
Correct.
Yeah.
Correct. You could buy a much larger policy for that, to the extent that like the participating policy, there's a decent chance that it will never reach the guaranteed cash values of a much larger policy.
Of course. Yeah. Well, and that depends on the dividend scale, I guess, right?
That's totally.
Yeah.
So when you see like an illustration of, look, you can buy this participating policy, but look at the future cash value. Look how high it's going to be. I always want to see the illustration at least current dividend scale minus 1%.
Yeah.
And I usually want to look at it at current dividend scale minus 2%.
Yeah.
And when you run those comparisons beside a guaranteed whole life policy, the cash values of the participating don't look so attractive. So you end up paying much higher premiums for the same amount of coverage, with potentially more to show for it if policy dividends are great, but they're not by any means guaranteed. So you could end up being like, well, I should have just bought the guaranteed policy. Oh, well.
Yeah. But what if dividends go up, Ben?
Yeah.
What if it's plus 2? I mean, there's risk there, obviously.
You're taking risk there. And I would rather not take that risk. Like if I wanted higher expected returns, I would buy the guaranteed whole life policy for the child if I wanted to do this, and then invest the difference in stocks.
Interesting. I hadn't thought about the non-participating policy. I didn't get a quote for that, but
I like the arguments about there's a little bit of legal diversification in there, creditor protection, whatever you want to call it, and the tax diversification is a real thing because life insurance does get different tax treatment than other assets. So that's a legitimate argument.
I feel validated. Thank you. I am going to buy it now that you've rubber stamped it for me. Thanks, Ben. That was the entire purpose of this episode. I just wanted to get Ben's opinion live so that when I buy it, he can't make fun of me later.